Hey guys, it's Brandon here, and we're on site today in sunny, beautiful Myrtle Beach, South Carolina, right here on Kings Highway, one of the most heavily trafficked roads outside of a 10-unit short-term vacation rental property. It's a beautiful apartment complex. It's bringing $558,000 a year in gross rental income. Got a 9% cap rate. Guys, it is where you want to be. You're walking away with $92,000 profit a year if you pass it off to a property manager. It is a stunning investment. Now, in this video, I'm going to walk you through a profit and loss statement. We're going to see just how much income is coming in. What are all the operating expenses just last year to include your principal and interest, and then how much profit you can make. We're also going to look at your mortgage data, explain all the financing for commercial property. We're going to look at your taxable income and see how it's going to impact you over a 5-year hold. What do you have to pay on your taxes? What can you write off? We're also going to look at cash flow. What exactly is hitting my account each and every year over that 5-year period? Finally, guys, we will take a look at what you can resell this property for after 5 years. You know, basically $5.1 million, and how much you're going to walk away with in cash and after-tax proceeds, and that cash that's hitting your account and that's in your pocket. Now, yes, we will take a tour of the property. You're going to get to see it. It's going to be stunning, wonderful, beautiful. These units are pristine. You will like them. And we're going to hop into some other things I didn't mention, like appreciation. Now, guys, I want you to make a savvy investment decision. I don't want you to make the amateur mistakes that lots of other amateur investors make when investing in commercial real estate in our market. I want you to win, and I want you to win big. So I've basically modeled this whole deal for you so that you don't have to worry about it and you can be educated and learn. It's all here, right here in this video. So please watch the video through to the end. Hit that like button, hit that subscribe button. I don't want to hold us up. Let's get in here and check this property out now. You'd like to invest in commercial real estate. I'd like to show you how these properties make profit and break down all their expenses so you understand how they operate, how they appreciate over time, and how this will impact your taxes. I'd also like to let you know the property's cap rate and how it compares with similar properties in the market, how the location best services its users, and the potential for future growth. I'd like to fill you in on the historical and future occupancy trends, as well as potential management structures affecting the investment. And we won't miss the investment's risk profile nor the best exit strategies. Yes, we'll cover the condition of the property, any value add potential and repositioning, but we'll also dive into special topics like customer base, market positioning, and marketing and booking strategies when it applies. And if you stay tuned until the end, I'll show you my top picks for the best commercial real estate deals that have generated the most annual profits, have the highest appreciation, and the best tax implications. So no matter if you're a first-time investor or a seasoned professional transitioning into the real estate game, or perhaps simply a casual investor looking to relocate to the beach to live, play, and invest so that the passive income can support you in your retirement years. Whether you have 20% to pay down because you're financing or you're a cash buyer, if it's a commercial real estate investment that you're after, you'll be better because I'm aiming to give you a 10 times return on your time for watching my videos until the end. Now guys, we are on site today right here at 404 2nd Avenue North in Myrtle Beach, South Carolina. We have a 10-unit apartment complex that allows for short-term vacation rentals and long-term rentals, as you can see here. You got parking, you've got excellent landscaping. There's your places across the street, other kind of units. Not much competition in my opinion. Look at that. That's not competition. Got some houses down this road. Now, down this road, you are only 3 blocks from the beach. So let's kind of look. If you can see down the way here, that blue building at the end, that's the ocean, and that's a restaurant called Wicked Tuna that's oceanfront. Now, this is one of the most heavily trafficked roads in Myrtle Beach. It is called Kings Highway. I'm going to get you over here. Again, one of the most heavily trafficked roads in Myrtle Beach is Kings Highway. and it is a very happening spot. We've got a Waffle House right here up the road. We've got a oyster place, Noisy Oyster. We've got Bargain Beachwear. There's an El Cerro Mexican restaurant here. Across the street, we have a Brazilian restaurant. We've got Whiskey Roots here, as you can see. But down this corridor, this is a commercial corridor in our market. There's all kinds of businesses, and it's a heavily trafficked road. This is the subject property. Just want to walk you around the side of it so you can see it real quick. Now, guys, you have a building, of course, here. Plenty of units here. And then you have another building just here.
I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the strong rental demand from a growing population. The city's population grew by over 20% just in the last decade, with a significant portion of new residents moving here due to the low cost of living, warm climate, and access to beach amenities. I believe you should invest in commercial or real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the tourism-driven economy. Tourism accounts for over 25% of the region's economy. The demand from tourism-related workers ensures a steady flow of renters in multifamily units year-round. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the affordable property prices and high cap rates. With an average cap rate for multifamily properties being typically around 7 to 8%, our market is higher than national averages for coastal areas, offering strong rental yield potential. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially in multifamily properties because of the potential for value-add investments. Many properties near the coast have strong locations but may be underperforming due to outdated facilities or lack of amenities. Renovating these properties can create significant upside for potential investors.
All right, so let's get inside this unit and check it out here. Now, you'll notice absolutely stunning flooring as soon as you walk in. A little bit wider of a hall. We have 2 doors to our right and left. This is your first room. Of course, ideal for Airbnb. Look at that bunk bed situation. You've got your flat screen TVs, of course. You've got a restroom en suite, as you can see. And, of course, that tub shower combo. Now, let's get across the hall here to our next room. Absolutely stunning flat screen TV. Good full-size bed. You do have a closet right here in the corner, as you can see. And, of course, your own ensuite restroom. Very nice, very tasteful with that tub shower combo. Got a nice hall. Now, this is the main communal area. We do have our living room here. It is open concept. We have our kitchen here. Let's start with our kitchen, guys. As you can see, let's talk about the bar. That's going to show up great in Airbnb photos. Nice granite countertops. You do have a dishwasher, dual sinks, appliances, stove, microwave. Come on. Everything you need. Refrigerator, and it is modern, as you can see from the hardware in the cabinets. In the corner here, we are going to have a washer and dryer combo, which is excellent for those winter month rentals that are more longer term. It's going to work out well for doctors, nurses. Here's your masters. As you can see here, you have your own desk, which is great for executives. Boom, boom, boom. Very, very cool setup. Flat screen TV, of course. Now, this is going to be a closet here in this corner. And we do have, let's see if I can get out this door, a very cool back patio. I'll just give you a quick glance at. That is a storage here out back for this particular unit. And there's your master again, of course, ceiling fan, light. Now we have a communal restroom, as you can see here, tub shower combo. Definitely excellent use of the space, and it is not cramped. I just want to point that out. A lot of bathrooms are cramped. It is not cramped. All right, here's our last bedroom here. As you can see, king size bed. You've got nightstands, natural light, flat screen, of course. Another closet here in the corner. And again, another entrance to the patio out back. Here's our road. Pretty straightforward. Now, you do have a dining room table here. Very, very cool. Of course, that flat screen TV. And that pretty much wraps it up right here.
I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, because our market has been the fastest growing market out of the 150 most populated markets for the past 3 years. Over 90,600 people relocated to Myrtle Beach, South Carolina in 2023 alone. This means increased demand for commercial space like retail, multifamily, office, and industrial, and ultimately excellent annual profits and appreciation. Now, for retail, more residents equal more consumers equal higher rental sales potential. This drives up rents and occupancy in retail centers. For multifamily, higher population boosts demand for rental housing, pushing rents up and lowering vacancy. Now, for office, job growth typically follows population growth, increasing demand for office space. For industrial, more people means more consumption and e-commerce activity, increasing warehouse and last-mile logistics demand. Ultimately, the return on investment impact is higher rents, lower vacancy, and rising property values that drive higher net operating income and appreciation. I believe you should invest in commercial real estate in Myrtle Beach, South Carolina, especially oceanfront hotels in the hospitality industry, because of the 20 to 22 million tourists that visit our market each year, which is the #2 vacation destination on the East Coast. High tourism equals steady demand, making it one of the most visited beach destinations in the United States. Our oceanfront hotels benefit from consistent seasonal occupancy, premium nightly rates compared to inland properties, and repeat visitors including families, snowbirds, and golfers.
All right, so let's work through a profit and loss statement, as is how this 10-unit apartment complex sits at 404 2nd Avenue North. Now, guys, of course, it's 10 units. The ask price on it is $4.5 million. Your acquisition cost, that's going to be your attorney, your inspection, and your broker fees. You're looking at $91,700. Your loan cost is going to be 2% of your loan. That's $67,500. Now you take your mortgage out of that, and you've got and that mortgage is $3,375,000. That gives you your initial investment. So if we start with our purchase price, we add in those acquisition costs, we add in those loan fees, we take out that mortgage, and we are left with an initial investment to get into this property of $1,284,200. That accounts for the 25% down, and it does assume that you're financing 75% of the purchase price. Now, your net operating income, that's $418,159.08. That's how much income you have after your operating expenses. Now, that does not include your principal and interest, though. Now, your gross rental income or your gross operating income for this property was $558,159.18 just last year. Yes, these 10 units are doing short-term vacation rentals, and they are driving in $558,000 a year. Now, I've got you at a 10% property management fee. The current owner self-manages. I'm saying, hey, you're going to have to pay somebody at least 10% to manage this property. That's $55,815.92. If you self-manage it, you can add that $55,000 to the bottom line, which I know you can see right there is $92,000 profit. Guys, we're talking at $140,000 profit a year if you self-manage. Now, your gross rental income subtotal, let's work through that. You got your gross rental income of $558,159.18. You take out the 10% property management fee, you're left with $502,343.26. Now, your principal and interest was $269,447.52. I will go over your mortgage data in just a minute. I'll break down exactly how I arrived at that number and what your financing looks like. Your cleaning and maintenance, which is pest control and general labor, was $17,505. Your legal and common area maintenance was $5,636.38. Your repairs, that's going to be painting, plumbing, flooring, and other, were $14,415. Your supplies were $5,466.88. Your utilities, that's electricity, water, insurance, and taxes, $92,390.38. And then your capital expenses, which in this instance last year were appliances, are $4,586.46. Now, if you add all of those operating expenses together, you've got a total operating expense subtotal of $409,447.62. If we take the gross rental income subtotal up top of $502,343.26, we subtract the total operating expense subtotal down below at $409,447.62. Yes, we are left with a projected profitability to the tune of $92,895.64. Guys, that's a cash-on-cash return of 7%, and that does also give us a cap rate of 9.3%. Now, here's what I want you to think about. If you self-manage like the current owner does, we're talking $140,000 a year in profit. This property is only blocks away from the beach, and I stood intentionally on this road right here for you to see that it is on one of the most heavily trafficked roads in Myrtle Beach, South Carolina. It is in a prime location. Now, your current rental income per unit is $55,815.92. Your repairs, I'm going over your notes there at the bottom, guys. Painting was $4,340, plumbing $2,660, flooring $3,115, and then they've got other on the profit and loss statement, came in at $4,300. Not sure what the other's for. Your electricity on the unit was $26,459.95. That's $2,205 per month. Your water was $5,810.23. That's $484.19 per month. Your insurance was $28,720.20. That's $2,393.35 per month. And then your taxes were $31,400. That's $2,616.67 per month. Guys, where can you find a gorgeous apartment complex that is only blocks away from the beach and allows for short-term rentals, giving you great rental flexibility for this property? If you need to pivot, I know exactly where. Myrtle Beach, South Carolina, right here at 404 2nd Avenue North. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. All right, so we are on Kings Highway, which is a heavily trafficked road. It's one of the places that you want to be in Myrtle Beach, South Carolina. There's no doubt about it. Now, I'm going to take us on a quick walk to the beach so you can see how far it is, but I'm going to cover your mortgage data and some other numbers. Guys, the amount of your mortgage was $3,375,000. The interest rate was 7%. And by the way, that's the property back behind us. Interest rate was 7%. You might be able to get it at 6.5. Anyways, amortization period, we got 30. Loan term, 5 years. Payments per year, 12. Periodic payment, you're paying $22,453.96. Your annual debt service, if you take that $22,453.96 and multiply it by 12 payments each month, you are left with $269,447.60. $2,258.52. Your loan fees, typically it's going to be 2% of that loan. That's $67,500. Now let's work through your appreciation on this property. We're going to do a quick snapshot in history of how much it is possible to make on a property like this in appreciation. Again, a 10-unit apartment complex that allows for short-term vacation rentals. Now, in 2006, we've got a sold price of $250,000. You fast forward to 2022, it's sold for $2,500,000. That's an appreciation to the tune of $2.25 million, 900% appreciation. That's essentially $140,625 a year. Now, guys, this is what I want you to think about. That's on top of your annual profits. That's on top of your tax write-offs. We haven't even got to tax write-offs and depreciation and all this other sort of thing, which we will get to in just a minute. But this is what I want you to think about. He bought it for 2.5 and is selling it for 4.5, and he's already shown you it's a rent-stabilized asset. That's $2 million. He bought it in 2022. He's selling it in 2025, and he's in a pocket, hopefully somewhere around $2 million. I think it's well worth it. Very smart deal. But it just goes to show you that commercial real estate, especially apartment complexes that have flexible leasing options. You can rent it as a short term, you can rent it as a long term, especially those short term rentals. They are where it is at in our market. I found a hotel oceanfront more recently, a few months back. The guy made $5.1 million buying it cheap and selling it when the market went up. It's that simple and that easy. Myrtle Beach is ripe with value-add commercial real estate opportunities for the savvy investor. Now let's go over the unit mix, guys. Again, he's got 10 units here on site. They're all 4-bedroom, 3 bathrooms. They are all bringing in $55,815.92. That is 40 total bedrooms, 30 total bathrooms, and that's going to be, again, the entire complex is bringing in $558,159 a year. Just last year, that's what it brought in. Now, guys, we're still walking to the beach. We're only 3 blocks from the beach. Now, let's understand your depreciation. Purchase price was $4.5 million. Your acquisition costs were $91,700. That gives you an original basis of $4,591,700. Next, we've got to figure out what our basis of improvement is. We need to know what the improvement value to total value is and get that ratio. So that way we can then apply it to the current purchase price and know how much of the property is depreciatable so that we have a defendable basis that will hold up for depreciation if we ever get audited. That simple, that easy. Now, we're going to go essentially to the local courthouse records and see what they assess the property at, because that will give us a defendable basis, for depreciating this property. Obviously, if that government agency says this is what the property is valued at, and we're depreciating it based on their metric, it's given us a basis, a defendable basis to stand on, rather than just hypothetically choosing a number or arbitrarily choosing a number and thinking that that's going to hold up well with the IRS if you ever get audited. Now, our improvement value was $1.197492. The total value was $1.521137. Therefore, the basis of improvement was 79%. In other words, the improvement value to the total value was 79%. We take that 79% and we apply it to our original basis of $4.591700. That's going to give us an improvement basis of $3,614,746.09. Now, that's what we are depreciating this property at. Now, I stopped real quick just to show you that we are on Ocean Boulevard, as you can see. Just right up the way, we have Wicked Tuna, which is a really, really cool restaurant. And as you can see, just down that way, we've got Oceans One Resort, a phenomenal short-term vacation rental oceanfront condo. And guys, that pretty much puts us on the beach. Just a little bit further down, that's an oceanfront place. It's called the Windsurfer. And then you have the Holiday Sands further on in the distance. But the point is, in what? A 3-minute walk, we're oceanfront. That simple and that easy. Now, I want you to be able to see what's on the other side of the road here, so I'm going to walk back. Let's finish our numbers. All right, your depreciation deduction. You have acquisition years, you have holding years, and you have disposition years. There's something called mid-month convention that we have to observe according to IRS rules. Ultimately, the IRS gives us some tables and says, hey, you have to take into account mid-month convention when you're depreciating this property. You can't buy, for example, you can't buy the property in June, but write off a full year's worth of depreciation. So they give us tables to be able to calculate these numbers for both residential and non-residential commercial properties. So that way we're depreciating the numbers correctly based on what month it is. All that being said, I've looked all this information up. I have it all here on the screen for you. In our scenario here for a model, we're going to assume basically that you bought the property in the acquisition year. You're only going to be able to write off 11 and a half months. In the holding years, you write up a full 12 months. And then in the disposition year, you'll only be able to write off 11 and a half months. That simple and that easy. You can see there we've got your depreciation deduction years 1 through 5. We've got your improvement basis for all of those years. We're multiplying it by our IRS figures, and that's going to give us the depreciation deduction that we can take each and every year on this property. I'm assuming you're going to hold it for 5 years and sell it in the 6th year. Your total depreciation on this property is going to be $646,244.31. You want a broker who knows how to figure out how this is going to impact you on your taxes. And they work hand in hand with a solid CPA to make sure that you're in the right place at the right time in the right investment. Just a quick note on the exact amount of property taxes. In 2024, the exact amount of property taxes was a whopping $20,990.64. And I want you to know that this property is not in a flood zone. As you can see on your screen, it is in a zone code X, which is an area of minimal flooding. I get calls and emails every day from investors just like you looking to make their move into the Myrtle Beach market. They want to invest in short-term vacation rental properties. They want to invest in oceanfront condos. They want to know where the best deals are in our market. Well, guys, you're talking to the right person. 843-360-1737. I'm going to help you put your hands on the best deals in our market. If you're a first-time investor or a seasoned investor, if you're 1 year, 6 months, 3 years out, I don't care where you are in the investing process, pick up the phone, give me a call, send me an email, shoot me a text message, and let one of the many stories on our channel be one of your stories. All right, guys, let's work through your taxable income. Guys, we've got a gross operating income, that's your rental income for the property in year 1 of $558,159.18. You have operating expenses of $140,000. That does not include your principal and interest. That's why there's a difference between the profit and loss statement I originally showed you and this statement here. The whole point of the taxable income is how is this going to impact me on my taxes? Now, you got your gross income minus your operating expenses. That's going to leave you with your net operating income, $418,159.08. Now, you can write off the interest on your mortgage for your first year. That interest write-off is $235,163.92. Your depreciation, you can write that off too. That's going to be $125,973.90. The amortization of loan cost, that 2% of the loan that you had to pay out in the first year, they let you write it off over the life of the investment evenly. So basically, you can write off $13,500 a year if you own it for 5 years. We're going to write that off. Now, we have our net operating income. We subtract out our interest on the mortgage, we subtract out our depreciation, we subtract out our amortization of loan costs and fees, then we're left with the real estate taxable income. Now, I'm going to assume that you're in a 37% tax bracket. You could be in a lower tax bracket for sure. If you are in a 37% tax bracket, you're only going to pay 37% of that real estate taxable income, which is only $16,102.87. Now, for the next 5 years, I've escalated our rents by 2%. I've also escalated our operating expense by 2% in keeping with inflation. It's that simple and that easy. Let's work through your cash flow. Bottom table on the screen, got your net operating income, $418,159.08. Your annual debt service was $269,447.52. Your funded reserves, I'm saying you're going to put back about $4,000 a year into a reserve account. That's going to give you your cash flow before taxes. If you got net operating income coming in, you take out annual debt service, you take out funded reserves, you've got cash flow before you pay any taxes. That's $144,990 $995.73. And then we're going to take out our tax liability because we got to pay taxes, which we already calculated at the table above, which was $16,102.87. That's going to leave us with our cash flow after taxes of $161.98.60. Let's work through selling this property in year 5. I'm going to assume the cap rate's going to stay the same at 9%. In other words, things aren't better, things aren't worse. It's just as it is, just as it sits. You got your up top, you'll notice your mortgage balances. You got your principal balance each year, and then your total unpaid balance each year. Now we've got that sales price of $5,125,172.25. All right, how did we arrive at that? Ultimately, we took the year 6 net operating income, we divided it by the cap rate on the property, and that gave us our sales price. That simple, that easy. Your calculation of adjusted basis. What does the IRS say that the property's worth on the date that you sell it? Ultimately, guys, we've got your basis at acquisition of 4.591. We've got your depreciation taken over the life of the investment at 646, 244.31. We're going to basically take your basis at acquisition. We're going to subtract out the depreciation that you wrote off. That's going to give us our adjusted basis at sale. The IRS says this property is worth $3,945,455.69. That simple and that easy. Now let's calculate your capital gain on sale. Ultimately, guys, the sale price was $5,125,172.25. Your cost of sale for brokerage fees was $205,006.89. You got your adjusted basis at sale. That's what the IRS says it's worth. Again, that's $3,945,455.69. Now, that's going to give us, if we have our sale price, we subtract out our cost of sale, we subtract out our adjusted basis, that's going to give us a gain of $974,709.66. If we take our straight line depreciation from that number, we are left with a capital gain from appreciation of $328,465.36. Now, your unamortized loan costs, we have to add those back in, but they are a negative number at $67,500. That's going to bring our ordinary taxable income to $260,965.36. Finally, guys, let's work through that calculation of sales proceeds after tax. All right, guys, very simply put, your sale price was $5.125 million. Your cost of sales with broker's fees was $205,006.89. Your balance of funded reserves was $18,579.13. Your mortgage balance was $3,176,941.11. That's in year 5. That's the mortgage balance you have on this property. Now, if you have your sale price, you take out a cost of sale, you add back in your funded reserves, you take out your mortgage balance, that's going to give you your sales proceeds before tax. That's $1,761,803.37. Now we're going to subtract out our tax on ordinary income at 37%. Essentially, we took that $260,965.36 of ordinary taxable income in the capital gain on sale calculation. We multiplied it by 37%, assuming that you're in a 37% tax bracket, and you officially owe $96,557.18. Now, we also took out your tax, your depreciation recapture tax. In other words, the IRS is like, hey, we gave you all these depreciation write-offs for $646,000. We want to get 25% of that back. That's $161,561.08. And then finally, they also want to get a capital gain recapture tax of 20%. That's going to be $65,693.07. Well, guys, if you have a sales proceeds before tax of 1.7, you take out 96 for ordinary income tax, you take out depreciation recapture, you take out capital gain recapture, you are left with a sales proceeds after tax of $1,437,992.04. There are 3 major numbers I want to bring your attention to. Number 1, annual profits. If you're walking away with $92,000 a year profit over 5 years, we're looking at around $460,000. And that's with a property manager. That's with you having hands off. If you are self-managing this and you're hands-on, we're talking about $140,000 a year annual profits. That's $700,000 a year over a 5-year hold. Additionally, you've built equity in the property, and all of the tourists, the 20 to 22 million vacationers that visit the #2 vacation destination on the East Coast are paying that equity payment, that mortgage balance for you every single month. So you've built up equity. And then finally, you've got your sales proceeds after tax due to the appreciation. You're pocketing $1.4 million. So you brought in $460,000 in annual profits. You built up some equity in the property that's going to be yours, and you're walking away with an absolutely stunning $1.4 million in after-tax proceeds. Not a bad deal whatsoever.